Welcome, everyone, to our fifth session of our MEVCA Future Readiness series, where we try to help our ecosystem, private capital markets in the Middle East foresee and evaluate the company decisions from a right angle, trying to bring perspective from peers in the industry. For those of you who don't know me, I am Paula Mateos, Executive Director at MEVCA. Today, we have with us Philip Bahoshy, founder and CEO of MAGNITT. MAGNITT, as most of you already know, is the leading private markets data intelligence platform for emerging venture markets, offering a wide range of products and information. Philip himself has become one of the most trusted voices on venture capital in our region. Beyond running MAGNITT, he's a frequent commentator on emerging market trends, a regular on stage at the region's biggest ecosystem events, and someone who has done more than most to bring transparency and rigor to a market that historically lacked both. Today, Philip is going to walk us through MAGNITT's Q1 2026 update, decoding MENA VC trends amid geopolitical uncertainty, and share the top 10 takeaways from the latest report. Given everything happening in the region right now, there are few people better placed to help us make sense of the numbers and what they mean for the months ahead. Philip, welcome. The stage is yours.
Thank you. Thank you very much for a very kind introduction. I hope you're all keeping well and safe. I'm going to do two things in the presentation. I'm going to start by giving you a little bit of an overview of some of the things that we've done at MAGNITT with regards to the war, and then dive into the Q1 data. For those of you that may not be familiar, and as Vala kind of mentioned, we cover emerging market private capital, so private equity, venture capital, credit for Africa, the Middle East, and Southeast Asia. For those of you that may be clients but are not, we published several reports in the last couple of months talking about the impact of the war on venture. We published a report quite early on a scenario analysis on the likely implications and the areas of weaknesses in the MENA venture ecosystem. And then we identified 5 pillars specifically that we thought were... Oh, you can't see the slides? Sorry, one second. Can you just confirm? Can you see the slides? Yep.
Yeah.
Great. And then we did a report on the 5 pillars that we thought were areas that need to be watched. I'm open to any challenges from people on their thoughts. And actually, since then, we've had multiple conversations with clients. We've had multiple conversations with different ecosystem players. And there's several kind of podcasts that are beginning to come out. But what I noticed was that there was a bit of a vacuum in the ecosystem talking about what was actually happening in this space. And thanks to MEVCA and many other entities, we've started to see more kind of public discussions and discourses. An area where we're used to having conferences has now gone back online, similar to what we saw in COVID. So to share some of the things that we thought about at MAGNITT with regards to this. Everyone is looking at oil prices. Everyone has it on their second screen, is trying to understand what's happening in terms of the public markets. Oil has become the indicator now for the investors' appetite of the risk factors that are linked specifically to the war itself. As a result of that, we identified 5 areas that were most impacted in venture that have come as a result of higher oil prices that we've been witnessing in the last couple of weeks. Naturally, it creates a inflationary pressure for the wider ecosystem. That's the economy in general, where prices are likely to be driven higher, given higher oil prices, cost of travel, cost of trade, cost of supply chain. And as a result of that, many startups in themselves may be facing higher operating costs and challenges with the cost of goods. Second, I've been a big proponent in the last 4 to 5 years on the impact of interest rates on capital availability. Now, naturally, as oil has created some inflationary pressures, and as many central banks, including the region here, follows what happens in the US, we started the year off a record year of venture capital. We saw a record growth in terms of global venture. We started seeing up to 4 cuts in interest rates last year alone, and a cycle that's gone back almost 18 months. But now we're in an environment that, despite starting the year with at least 2 cuts being predicted, we're now discussing, with a new Fed chair coming in, the potential of stagflation and interest rate hikes. Naturally, as interest rates come down, cost of capital becomes cheaper, valuations become slightly more attractive. IRR calculations become more interesting as interest rates kind of begin to stay flat, if not the risk of them becoming more expensive. Then you start having the crowding out effect again, where will that capital come from as people start to move towards fixed deposits, treasuries, and other areas, and interest public markets now at record highs. The third, and this is a thematic that I've been kind of preaching publicly as well as in many of our client discussions, is what is the international investor appetite and risk for the region? Naturally, there are different types of international investors that are interested in investing here in the region, and I'll come on to that in a second. But the regional instability has created a temporary repricing of risks. I was listening, for anyone that's familiar, Lulu's podcast with Khalid Talhouni of Nuwa Capital this morning. They were specifically talking about how several international investors are putting term sheets, waiting and biding their time, and how does that impact venture here in the MENA region? 405 came off a little bit of what we saw during the COVID pandemic, and I'll come on to some of the similarities that we've seen from that area. Deal formation friction. Naturally, we were in an environment where we were traveling at conferences. Anyone that was here before Eid was jumping between Saudi, Qatar, UAE. Now you've been in an environment where people have been somewhat constrained. There's been a delay, if not a push, of all of the ecosystem events until September. And naturally, this slows down and creates an element of friction, albeit with all the tools that we have for virtual meetings, for new investor introductions and potential follow-on conversations that people have been having. And finally, investor risk aversion. Now, I've spoken to many investors at this point. There are some that have dry powder, some that have raised funds only quite recently and are able to deploy that capital, and therefore risk aversion may be a little bit lower. Those that are fundraising and don't have the capital that they can actually invest into new companies. But even then, as Khalid was mentioning just this morning on the podcast, there are local investors that are also pulling term sheets because they probably anticipate that valuations are likely to get cheaper if you were to wait several months. And this was something that we definitely witnessed during the COVID pandemic. There is no cost to waiting for an investment to see if valuations come down as people navigate the geopolitical situation, which has yet to get to a point of certainty or calm. Despite the ceasefire, which has now been pushed forwards, there's still a lack of certainty as to when normality will come back. And so in the second report that we published, which highlighted where do these areas of friction impact venture capital. Specifically, we looked at international capital and the role of international capital here in the region, late stage capital, which is likely to be more impacted than early stage capital, the impact that it'll have on deal pipeline, the exit liquidity, which I had already started at the beginning of this year, calling an orange flag as one of the areas for the region that needs to kind of continue to be developed to see that flywheel of liquidity coming back to investors, and the role, if not concentration, of sovereign capital here in the region, namely the GCC, UAE, and Saudi Arabia. So a couple of slides that I'll share from that report. And again, if anyone's interested, please do reach out on LinkedIn, or I'll share my email in a second if you're interested in getting the detailed reports. Last year, we saw that 50% of all investors investing in MENA-based companies came from outside of the region, 23% from the US, and 50% of capital came from investors that came from outside of the region. Now, that is a large percentage of the wider ecosystem that is coming thanks to a development of encouraging FDI investment. And even within the region, we see divergence. So in Saudi Arabia, a country that I've now come to understand is a lot more immune to the impact of the war from a geopolitical and at least from a venture capital perspective, sees only 30% of capital coming from international investors and 70% coming from local investors, despite there continuing to be attempts to attract international investors. But the UAE, which has done a lot to attract international investors, now has 70% of all capital coming from outside of the region, whereas only 30% comes from local investors at a declining rate. So each geography has a difference in terms of the concentration of international capital. But the question here is, what will happen to those international investors? I've been advocating that there's basically three buckets in that funnel. For those that have, and I was criticized for saying this on Bloomberg, but I repeat it again, boots on the ground in terms of their investors, they are less likely to be impacted by what's happening because they act as local investors. They are actively investing, seeking opportunities, better understanding the impact of what's happening in the region, and have clearly committed to the region and have a medium to long-term perspective. So I'm less concerned that they are going to be impacted, albeit similar to the local investors, maybe pausing their investment activity, weathering the storm. The second bucket are those that are potentially fundraising, who have made one or two investments in the region and are speaking to LPs to commit funds to bring themselves and position themselves with boots on the ground. Now, those people may be taking a risk-off mentality, engaging with LPs and the local VCs to understand what's happening, and are most likely to be returning in September, as many people are talking about that return of normality, where events will be taking place. And then at the top of the funnel, those that are interested in the region, it's not their core mandate. They may have made one or two investments, but actually now they focus on their home markets, take that capital, look to reallocate it to other areas that are definitely going to be impacted by the news flow of what's happening on the television. So the question will be how much of that venture investments will continue heading into 2026 and 2027 from the international participants. Now, I make the point here about growth capital. From all the people that I've been speaking to, similar to COVID, investors at early stage are less impacted than late stage. People that invest at seed or pre-seed have an 8 to 9 year horizon. There are great companies that get built out in this type of environment. A $1, $2, $3 million check will go a long way at potentially preferred valuations, and therefore we see less risk at the early stage. What we did begin to see at the end of last year was a pickup at Series A, Series B, and Series C investments. As you can see here, Series B investment almost tripled, and Series A investments almost doubled last year alone compared to 2024. The challenge is as you get later in the investment cycle, we already discussed the impact from interest rates, but you are usually investing because you have the visibility, or the startup has the visibility of a future investment round coming within 12 to 18 months. In this environment, are those companies able to predict another investment round in the next 12 to 18 months? And as you move towards Series B plus, you start going towards an exit window. Are we going to have a challenge of many of those companies going through M&As and or IPOs in the region, given the volatility that we're seeing in the public markets? And therefore, naturally, we anticipate that there's more concern with late stage investment over early stage investment. But this chart specifically doubled down on the point that I made on the first slide. Effectively, 70% of all investment capital in Series A came from international investors, and 50% of that capital was in Series B. So the first point that I'm talking about at a wider ecosystem perspective is even more acute as you go later in the investment cycle. It is always important to look at the funnel of the ecosystem. We've published 2 reports and we'll be publishing an update in 2 weeks on the funnel of success of the MENA ecosystem in terms of early stage startups that then go into Series A investment and beyond. 7.3% is the ratio of companies that have raised an early stage investment round that then go into Series A. To put this into context, Singapore is at 14% and the US is close to 25%. So even before this crisis was happening, we saw that we were below the average that we've seen in terms of international benchmarks. The question is, albeit I've said that early stage is less likely to be impacted than late stage, if early stage, starting with accelerator programs that may not look to operate in this uncertain environment, seed funds may slow down their decision making, pushing it to later in the year, and angel investors who tend to have a lot of their wealth tied up to the public markets that have been extremely volatile, slow down the investment at early stage, you may be slowing down the next generation of companies that will form part of the funnel of the wider ecosystem for years to come. And so the question is, how much of an impact will there be at early stage for the continual development of the pipeline? Exits, I highlighted that for all intents and purposes, this is something that I highlighted as an orange flag. We started the year by seeing a slight pickup in terms of exit activity. Two points that I think are interesting that we published in a report only 3 weeks ago, looking at all M&As in the last 5 years from the MENA region. 25% of all venture-backed startups that had M&As in the last 5 years were acquisitions from international acquirers. Again, we go back to, are those companies that are looking to acquire for regional expansion going to continue to be interested in making those acquisitions in 2026? 50% of the acquirers were later stage startups consolidating within their industry. Now, I was asked by a fund of fund, a very senior official, what do we learn about COVID that can be applied now in terms of the winners and the losers? What we saw in COVID was actually 1 or 2 years post-COVID, the winners became the biggest acquirers in the ecosystem, consolidating specific sectors within the markets that became attractive. We're beginning to hear people talk about defense, food security, even e-commerce potentially seeing a pickup of business activity. Do we start seeing winners consolidating in their specific sectors? The question is that going to happen in 2026? Or do we now see a slowdown in M&A as we then see a build-up of investor acquisition appetite heading into 26 and 27? IPOs, we published another report. We did a report and we will be creating an index of MENA venture-backed tech companies in the region that people will be able to monitor moving forwards. In that, we identified 14 companies that have received venture or are tech-backed companies that have listed. Before all of this, last year, we noted, which was a bit of a kind of flag for people to understand, 8 out of the 14 companies had negative returns on their share price over a 12-month period after their listings. And so one of the challenges was, are we going to see all of this flight towards IPOs in the next 12 to 18 months? Or will we see many of the companies that look to IPO go on a risk-off mentality and continue to build their businesses until the public markets has more stability and we see the opportunity for those companies to list here in the region? And finally, the question comes down to the concentration. What has always been a key strength in the region of the concentration of capital, both in terms of the total number of transactions and the capital deployment, here specifically looking at Q1 2026 versus 2025. In 2025, 71% of all transactions and 86% of all capital were from Saudi Arabia and the UAE. Now, the question is, what role will the fund of funds play in continuing to support the ecosystems over the next 12 to 18 months, where a lot of the reliance of this LP funding has come from those sovereign entities? So it's a question mark as to how each of the different geographies will weather the storm. It's clear that Saudi has been somewhat less impacted, but I think that there will continue to be externalities or network effects of this on the companies and the investor behavior heading into the rest of the year. So those are some of the key takeaways that we've shared, but we've done at least 4 reports specifically talking about the impact of the war on venture in an attempt to create a framework. As I mentioned, you may challenge me and say some of those things don't make sense, but we wanted to put speaking points that people can have with their LPs, with their startups, and with governments to lobby and share some of the challenges so that in 6 months, we don't look back and say we wish we did something, to potentially think about what are the challenges to take action now and not do that later. What I am going to show you is some of the data that we've been seeing already in terms of venture. Now, so this is the data that we've seen from CB Insights. Globally, venture looks strong. You've already seen close to 50% of the investment capital on global funding being deployed in the first couple of months of this year. Even here in the region, last year was a record year of venture capital investment for MENA. Emerging venture markets, we cover Africa, the Middle East, and Southeast Asia, did see a slight decline because, again, even then, when we look at the nuances, Africa and Southeast Asia had not caught up with the trend that we were seeing here in the GCC. But in MENA, we saw almost record amount of capital and transactions taking place. and we saw the return of the underlying ecosystem. So while we saw growth in mega deal investments, we also saw non-mega deal investments continuing to grow. I will point out, though, I don't think that we've seen the impact of the war in the data. So when we went back to COVID, MAGNITT used to publish many reports at the time. In Q1, off the back of a strong Q4, similarly, we saw a strong Q4 last year, and heading into this year. What's clear is that many of the investments that are either announced and or in the process of being signed tend to get held off. So Q1 data, with the war beginning at the beginning of March, is a reflection of deals that had been announced of 6 to 9 months in the making for the first 2 months of this year. And we also had both Ramadan and Eid slowing down announcement activity, very similar to what we saw in March Q1 2020. Even Q2 2020, which was stronger than Q1, was a buildup of deals that were probably not announced at the beginning of the onset of COVID, that were delayed and pushed into Q2 2020, with some new rounds being announced. But the real impact of what we're witnessing is most likely only to be reflected in Q3 2026, as it was in Q3 20, and the return of investment activity will only reflect in Q4 later this year. Needless to say, we also have the summer impact effect of what has historically always been a slowdown in regional investment. And therefore, what we put as a framework in one of the reports, pre-conflict pipeline was extremely strong, conflict disruption window with probably few new deals being initiated, summer seasonality compounding the impact of that slowdown, the true visibility only coming in the Q3 and Q4 data. So I highlight that because as we run through the data in the report, this is really a reflection of the continued strength and the early signs of any slowdown. So we did see continued investment at later stage capital. This was a trend that we had already seen in 2025, contribution of $55 million plus of greater than 20%. It's now constituting close to 30% of all the transactions that were taking place in the first 3 months of this year. In terms of geographies, the same countries, Saudi Arabia, seeing more transactions than anyone else, but a slowdown significantly. Here, I think, again, the reporting of deals because of Eid and Ramadan already slowing down compared to last year. And in terms of capital deployment, Singapore seeing a very strong start to this year, the UAE stronger than Saudi only for the first 3 months of the year. And again, 3 months of data isn't indicative of how the year is going to pan out. What was interesting, though, when you look at the total number of investors, the local international investor participation has already dropped off in the first 3 months of this year. Only 26% of all capital came from international investors versus the 74% of regional investors. And actually, only 55 international investors participated in investments in the first 3 months of this year. A caveat, again, it's still early to say the true impact of their international investor participation, but it's clear that that was already beginning to kick in with some concern of what was happening in the region already being discussed in January and February. Here you'll see the breakdown of those investors. Saudi now being, if you remember the chart that I showed earlier in the report, 24% from the US being the largest percentage, 27% of investors coming from Saudi Arabia, the largest contribution of investors who are actively deploying capital into the regional ecosystem, and 36% of the capital coming from UAE-based funds into the regional ecosystem. The story of investments remains the same. Fintech, fintech, fintech. Nothing has really changed. We haven't really seen the winners, shall we call it, come and present themselves because it's too early for those investments to come into the data. So this is really a continuation of the trend that we saw in 2025 into 2026. But AI has been the leading thematic. I mean, interesting to note here, $226 billion of AI investment in global venture. I think the stat was last year, close to 75% of all venture capital went into AI startups in the US, close to 50% globally. Here in the region, it was 23%. And so the flight to AI is something that we now track. So anyone that wants access to all the AI investments here in the region, what we saw last year was a record amount of AI investments. 850 million, almost threefold the amount of capital of 2024. To date, only 14 deals and $60 million of investment in the first 3 months. Again, I'm aware of several deals that were delayed because of the war and because of the PR visibility. We would anticipate some of those deals coming to fruition. I do believe that the adoption of AI becomes an opportunity in this current environment. And finally, we've already seen that slowdown in M&A transactions. Only 9 transactions, less than a quarter of what was witnessed last year. We have heard of several other M&A transactions. I've spoken to several brokers. There are a lot of requests for sales at the moment. The question becomes, where is the appetite for the buyers? And where are the strategic opportunities for acquisitions in this current environment? And will that get pushed to later this year? For those that are interested, I've mentioned several things. We published at least 4 or 5 reports on the war itself. One area of focus is the data on MAGNITT. I just mentioned 3 things that we're currently working on. We will have DPI calculations for the top MENA 100 funds on the platform available, as well as close to 900 individual funds as we map out the fund ecosystem on the MAGNITT platform for those that are interested in doing due diligence or comparisons. And we are also building out an LPGP directory for those of you that are fundraising, that are interested in understanding the LP contribution and who are the leading LPs on the ecosystem here in the region. And that will be available as well in the next couple of weeks, or sorry, months. And we've also mapped out the third, the acquisition routes, IPO data, an IPO index, and all of the acquiring types of companies that have been the most active in the ecosystem in our exit directory. So for anyone that's interested, please don't hesitate to reach out. I'm more than happy, Paula, to answer any questions that you have or anyone in the audience has that may be relevant or interesting.
Yeah, exactly. Thank you so much, Philip. I think it was really insightful, everything that you've shared with us. In order for everyone to share the questions, there's a Q&A box down in the ribbon, and you can type them there. Okay, so we will start with the first question. Philip, how do you see cost of operating across sectors affecting margins and possibility sustainability of the business operations, irrespective of the business models?
I mean, that's a question for us, investor and or a founder. I mean, the cost of operations, I think it's clearly going to be a matter of, I'm going to answer the question differently. When I was speaking to VCs, they have said that they continue to look to invest in this market and they have a lot of appetite, specifically those that have dry powder. But one thing that they've begun to ask their startups to do is look at the strategy around their operating models, including how their operating costs are going to impact their revenue, their margins in the next 12 months, 18 months, and beyond. So I think it's a question that each founder needs to start doing scenario analysis. And the only thing that I've been saying publicly in terms of advice is expect the worst and hope for the best, and start predicting what would be the worst case scenario and how your cash burn is going to be impacted given the current environment, including the cost of operations and how that impacts each of the individual startups.
Fantastic. Thank you. Okay, next question. How many of the factors across MENA can be applied to frontier markets in Africa, or are there any other risk factors to consider in that region?
In Africa?
Yeah.
I mean, number one, that there was a growing relationship that was being built between African startups into the GCC and the GCC into Africa. So naturally, in any kind of situation like the pandemic and this, people will start focusing on their home markets. So will VCs that may have been interested in investing into the wider African market focus on their portfolio companies and focus on home geographies is one area that may be likely to be impacted. For all of the African startups that may have been looking to raise funds and relocate to the GCC, is there a slowdown in their decision making to relocate to Saudi Arabia, UAE, Qatar, that have created a lot of incentive programs? And so, from that perspective, I can't speak to the specifics of local investment, which I think remains the same. Cost of oil may put inflationary pressure, availability of capital may be a bit of a concern from a LP or capital deployment perspective. But the reality is that those were going to be the case regardless of what was happening as a result of the geopolitics. The more directly impacted, and you could look at North Africa as an area that has, I was asked this question recently, or in one of the posts that I published on LinkedIn. The impact is more acute when many of the companies are relocating to the GCC to benefit from the sovereign funding, but then have their operating businesses elsewhere. How are they impacted when the next round of investment is likely to be impacted?
Thank you. Next question. Someone in the audience is saying that he's assisting a DXB-based startup currently in the fintech space, and they are gearing up to fundraise, having used the founder's equity up until now. How do you see seed and Series A valuations moving due to the war?
I mean, clearly you're going to see as I mentioned, it's in the everything is, it's a bit like real estate right now. Valuations are not going to reflect today. They will likely reflect in the next couple of months, but it is question of demand and supply. There are going to be a lot of people looking to fundraise and only so much capital. In fact, another report we'll be publishing in 2 weeks, 3 weeks, is a dry powder report. We'll be reviewing MENA's top 100 VCs and based on the data that we have available, aggregating the amount of dried powder that is currently available in the ecosystem to deploy. But as a result of that, we talked about the international availability of capital. Are they going to be more risk averse? What available of capital is there regionally? And it comes down to a matter of demand and supply. Are you in a sector that is attractive? Have you got good business fundamentals? Can you command a higher valuation? Or more likely, given that there's a constraint in capital availability, valuations in general will have a new risk premium placed on geopolitical risk, and therefore companies and investors will require lower valuations than they had probably asked for only 3 months ago. And that's why there is no cost to the VCs in sitting out and waiting, delaying a decision, as companies need to navigate using their founders' capital to then have to decide whether they accept a lower valuation or wait out for evaluations to return. So this, similar to COVID, creates a very new dynamic, whether it's healthy or unhealthy, that allows VCs to command potentially discounts on valuations in the absence of the availability of liquidity.
And what are the main metrics you look at and try to monitor over a 6-month period to evaluate the overall situation?
So it's interesting. We're building a dashboard on MAGNITT based on some of the metrics that I've just kind of highlighted. Number one, deal flow. Now, let me be clear. I'm saying all of this. I was asked by a client, is it such a bad thing that venture slows down? I don't think it's for me to say whether it's good or bad. I am just presenting the data. If you're a government, you've been trying to develop funding, ecosystem development, transactions, the market. You're trying to see companies increase their revenues. You have concerns around hiring and headcount, whether companies are going to have to let go of companies. Those are second and tertiary effects to the underlying venture ecosystem. But the metrics that we are going to create a dashboard for are total amount of funding and total number of transactions, total amount of availability of capital coming from international investors versus regional investors and the participation, specifically a review of Series A and Series B investment and whether there is a slowdown at later stage over early stage investment, M&A and exit opportunities, and that concentration risk. So effectively, the metrics that we've just mentioned are the five charts that I put up previously as will there begin to be a bit slowdown in those five charts that represents a venture slowdown from a numbers perspective.
And what about access debt in high risk conditions? What's the impact on startups and small medium businesses?
Yeah, I mean, Lulu and Khalid were talking about it this morning, talking about how many companies that are in the fintech space have been raising venture debt and credit lines to support. Naturally, if we run the risk that interest rates are potentially going to go up, as they have in some jurisdictions, then the cost of capital becomes more expensive. They were talking about the strategy around the business models and the availability of that debt being based on positive economic outcomes. If those economic outcomes become worse, the risk, the geopolitical risk of the availability of that venture debt becomes a nuance. Will they be able to continue to lend but at higher margins is a question I don't have an answer to. It's worth speaking to a venture debt or a credit expert. But my view would be if you ask me, Philip, nothing to do with MAGNITT, as someone who follows the public markets, my biggest orange flag, if not red flag, entering 2026 was credit default risk, private credit risks, and the underlying risk associated with debt. People have somewhat forgotten about it, albeit Jamie Dimon raised it only yesterday, and we're beginning to see some of the canary in the coal mine in the public markets with the inflationary pressure of oil, the risks of stagflation, the risks of interest rates being raised, the overall public market risk of credit default will only get further stronger or whatever you want to call it, exemplified. And that's going to be a problem for credit as an asset class in general.
And more on an international view, what do you think about new private equity firms and other asset managers increasingly announcing they are opening local offices? Do you think these are real commitments with the hope of actually doing deals or just symbolic?
I mean, look, it's not for me to judge on the individuals. I think that it isn't just largely symbolic. The region, and I remain extremely positive for the region. And let me make sure that that's clear. I'm not here being doomsday only. I remain extremely positive for the region. It's gone through a huge evolution in the last 10 years. I genuinely believe it is a financial hub that will only get strengthened in the medium to long term. And so when you see these private equity and hedge funds coming and setting up here in the region, they believe in the opportunities, the growth story, and many of these countries in the GCC have already proven a track record of overcoming challenges like this, whether it's the Gulf War, the Second Gulf War, Iran-Iraq War, COVID, 2008. And therefore, I think that it's not just symbolic, it is a commitment. How they weather the next 12 months will be interesting. And I go back to the three buckets that I alluded to. Those with boots on the ground, those that are still looking to move, those that are investing and actively only deploying from outside of the region. Those that are in the region are likely to be back in their offices. I came back to the office this Monday. We are back in the office. Many of those people are back in the offices. Those in the middle and the higher bucket may wait until September to come back to the region. And therefore, I can't speak to the individuals, but I do believe even Jamie Dimon himself from JP Morgan committing to the region as an area of growth for the medium to long term. So yes, we're in a geopolitically sensitive period, but I do believe that we come out stronger as a result of it for the next 10 years.
And from an international investor's perspective, you said that there was kind of a pullback. Are you seeing any specific types of international investors retreating faster? So US crossover funds, European VCs, or I don't know, any other type? Or
Too
no?
early to be able to say in the
Okay.
data, but I go back to that three buckets. The majority of the ones are later stage because it's a higher risk for the next investment round or an exit.
Hmm.
It's those that are deploying from international markets that don't have boots on the ground, that are probably more risk averse and watching the news on a daily basis. I can tell you for what it's worth, having recently come back, You are more consumed by the news outside of the region than you are in the region. Here you get on with things and it's your daily life and you're less impacted by the noise of the news. When you're outside of the region, you are impacted a lot more because it is your source of information as to what's happening in the region. So your international investor that is relying on your Bloomberg terminal, on your news headline that comes out from Al Jazeera, is likely to be more risk averse than one that is based here in the region, going out and meeting people in Saudi, UAE, and jumping on planes and meeting with clients. So I think it is those entities rather than specific assets, albeit I think late stage investors are much more impacted than early stage investors.
On the exit frame, with M&A transactions going down significantly, as you said, and a high historical reliance on international acquirers, what does this tell us about the current state of exit liquidity in MENA?
Look, as I mentioned, this was something that we were already discussing as kind of an orange flag for the region. We have gone through an extremely turbulent 5-year period, and exits are the flywheel of the wider ecosystem.
Hmm.
M&A had not quite picked up to record levels that we've seen historically, as per the chart that I've shared before. And I've often shared when we've looked at a 10-year analysis, less than 6.5% of all companies that have ever raised funds have actually seen a liquidity event that comes from M&A and IPOs. I exclude secondaries because that's extremely difficult for us to be able to calculate. Now, during good times, especially in 2025, a lot of discussions were being done to attract the international community, to attract corporates towards VCs and tech-backed companies, sorry, VC-backed tech companies, to encourage and facilitate attractive M&A transactions, consolidation within sectors, cross-geographical M&A to see a Southeast Asian, Middle Eastern 1+1 = 2.5 opportunity that can be bridged cross-geography. IPOs, a lot of conversations around the IPOs, albeit I think we're not quite there yet, and then need to develop the framework for IPOs. But I think that this environment definitely creates a further challenge for that exit flywheel, at least in the next 12 to 18 months.
And how do you see in this M&A frame the willingness of the US companies to acquire MENA startups?
Look, in any crisis, what do they say? I can't remember the saying, never let a bad crisis give a good opportunity. For those that are strategically interested in the region, they remain strategically interested. You are likely to be able to command better valuations. Will these companies be stronger in the medium to long term? For sure. Are you able to capitalize on the fact that this creates a discount in the region? So for private equity, which was the question earlier, this should be a hunting ground for companies that could be potentially interesting. I've spoken to a broker, as I alluded to earlier. There are a lot more sell mandates than there are for buy mandates in the market. That naturally creates an opportunity for M&A if you are looking to enter the market. But then from a strategic perspective, there are a couple of points. You usually have an acquisition for strategic access to a market. So it is not clear how the next 12 to 18 months pays out in terms of normality for that strategic access. You do it from a corporate perspective, but many corporates are also facing similar challenges to founders. And therefore, they are trying to work out how do they navigate the next 12 to 18 months, whether they're US or regional. And ultimately, when it comes down to valuations, I've been wrong several times, and I'm happy to admit it, in terms of when M&A was likely to happen, because as valuations dropped post the COVID pandemic, when interest rates went up, you forget that there are VCs who had raised at higher rounds that are unwilling to accept valuations for exits at lower than when they invested. And therefore, there is always a board dynamic as to whether to accept an M&A transaction if it is not favorable for the early stage or the previous round of investors. And therefore, to answer the question, strategically, it should be great for international acquirers to invest now if they have conviction. But naturally, unless they have boots on the ground, understanding what's happening in the region, they can also be put off by what they're seeing on the news.
And I think this is a very interesting question. Why do you think there are no major investments in food, pharma, manufacturing, and logistics? And still fintech is like the main investment in the region, even after the critical condition after the conflict.
Yeah, I mean, well, there's two parts to this. One, I don't know that there aren't deals that are happening. So again, that they will likely to reflect in the data in the second half of the year. But number two, it goes back to the exit point. I've said this kind of publicly. Risk appetite grows only when you have return on your funds. So as the exit flywheel kicks in and VCs are able to raise a third and a fourth fund with the success off the back of their first funds, their risk appetite to go into industries that require large amounts of research and development, patient capital, talent and engineering grows because they've proven that the e-commerce, logistics, and fintech models have paid off. In the absence of that risk appetite, investors will naturally focus on sectors that have the clearest path to exit. Having already been through the evolution of the e-commerce sector, then the transport and logistics, you've already seen the big success stories of Souk, Kareem that are well documented. We're now in the financial services disruption, which is a global disruption for which there is an identifiable problem using technology that can be solved for. And naturally, capital, both in terms of the appetite of investors, i.e., the total number of transactions that comes into it, and the bet that they're ready to put into it, which reflects in the amount of capital that's being deployed, tends to go into the financial services industry. You could also point to, which we've put in a MAGNITT report, the percentage of capital as a percentage of venture capital as a percentage of GDP. GCC geographies have some of the lowest percentage of GDP contribution from VC. Singapore, it's around 2.5%. Saudi Arabia, 0.2. So is there a role for patient capital for industries like manufacturing, hardware, pharma that requires patents and products that are not the business model of pure venture capitalists, and therefore they're not reflected in the MAGNITT data set? So there are kind of several points as to why that doesn't necessarily translate into the research.
And in terms of the AI investments, you said that globally they were hitting a record. But MENA is seeing a decline except in 2025. What explains this divergence? I mean, is it a structural gap or is just a lag?
Well, I mean, to be clear, the chart that I showed you, 2025 was 3x the amount of 2024. And actually, 23% of all capital was going into AI startups here
Mm.
in the region. So let's go back to the fact that, like, the US being always the front runner in any sector. And
Mm.
I share the Eli Habib quote of you can predict what happens in the region because it happens in the US, and 18 months later it's likely to happen in the region. We are effectively 12 to 18 months behind what's happening from a global perspective. So if you went back 2 years ago, 23% of all capital went into AI investment. The first 3 months of the year only showed, according to the data that I showed you, 14 investments for around $50 million.
Mhm.
I would answer that question in 12 months' time, as opposed to based on 3 months of data, because no doubt there are deals that are in the pipeline of conversation. But my point is also that to get to those big investment rounds of OpenAI, you need to have a fertile level of seed investments that become Series A investments, that become Series B investments. And it goes back to that funnel that we spoke about. We still need to be seeding the AI software solutions of the region that can become the open AIs, the Anthropics, and the likes in the months ahead or the years ahead. So we're still at the early stage of planting the seeds for the AI revolution here in the region.
Fantastic. I think we don't have more questions. So, Philip, thank you so much for your time and for all the insights. I think it has been like a really valuable session for everyone here.
Pleasure.
Thank you everyone for attending as well, and have a fantastic day. We will share the contact of Philip
Please do.
in
Yeah.
case you
I saw
want
a
to.
question on the reports. If you go to magnet.com, there all of the research reports are there. If you can kindly share a link to it, then for anyone that's interested, or
Of
connect
course.
with me on LinkedIn and DM me, I'll be more than happy to connect you with the team.
Of course. We will all stay in touch. Thank you so much.
My pleasure. Thank you.
Have a great day. Bye bye.
Take care. Bye bye.